In this video, we're going to go through a standard three-statement LBO modeling exam that is commonly given in private equity interview processes. So a couple things to note before we dive in. We're going to focus on the structure of a three-statement model. So this will include the entry assumptions, sources and uses, income statement, balance sheet, cash flow statement, debt and cash schedule, and returns. In subsequent videos, we'll layer in additional complexities and sensitivities, so the focus of this video is limited to building a fully functioning three-statement LBO model. So the prompt, which is displayed here, is also in your downloadable Excel file. I'm not going to read through every assumption given here, but at a high level, we're looking at a take private of a publicly traded company called Smile Corp. In a live interview setting, you most likely be given this assumptions tab, which will most likely be given in a PDF, occasionally be in the Excel itself, and you'll also be given an inputs tab, which we have here. So this is a historical income statement and historical balance sheet. We're assuming transaction closed 12/31/2020, so you have the 1 year historical income statement and the balance sheet at transaction close. So this will often be given in Excel. And so lastly, we have our blank Excel tab, which is where we'll take the test. So let's start by recording the assumptions that we're going to want to use, right? So it's best if you can put basically every hard-coded assumption that you're going to use in this model up front, as opposed to scattered throughout the model, right? This will make it cleaner. This will make it easier to change variables, right? So let's say instead of 30% purchase premium, we want to sensitize that to 20 to 40%, right? All your inputs will be up front, and this will keep the model clean and tidy. So let's go ahead and transcribe from the prompt the assumptions that we need. Right, so let's start with the purchase assumptions. Right, so share price, right? We know that's 27 from the prompt, right? So Smile Corp is going to be acquired at $27 per share. We know that the purchase premium is going to be 30%. There are 40 million shares outstanding. There are 8 million options, right? The strike price of these options is $13 a share, right? So we're going to use the treasury stock method to determine the dilution from these options. There are $15 million of transaction fees and $20 million of financing fees. Right, so these are our purchase assumptions, right? So now let's go ahead and write down our operating assumptions, right? So this will impact the projections. So starting with revenue growth, 7% revenue growth, annual R&D spend is 75, CapEx as a percent of revenue is 2%. And so this is all coming from the operating assumptions here in the prompt. All right, so basically taking this language, and sometimes this will be provided to you in a separate PDF, sometimes it'll be embedded in the Excel itself, right? But we can't link to this, so we're gonna transcribe it over here. Right, so depreciation as a percent of CapEx is 100%. Right, there are multiple ways to think about projecting depreciation CapEx. Right, you could do it in a waterfall. For the simplicity of this model, we're going to assume that depreciation is 100% of CapEx. We're going to amortize 1 million of intangibles. We're going to amortize our financing fees over 7 years. Right, so we have 20 million of financing fees, and the prompt said to amortize them over 7 years. All right, so we just want to put the 7 there. If you wanted to, you could set the formatting so it says years. All right, so you know what that's talking about. Min cash is 15. The rate on that cash is 0.5%. Right, so that's the interest income that we'll earn from our cash. The tax rate is 25%. And we're going to go ahead and build in a circularity switch here, right, which will link to our interest expense. So if the model roughs out, we can flip this to 0, turn off interest, flip back to 1, and the model should refresh. And so that covers our operating assumptions, right? So last thing we want to kind of transcribe here in the beginning are our financing assumptions, right? So in order to do that, let's build out a table, right? So with the debt, there's going to be the amount, the capacity that's for the revolver, right? The max you can draw on, the leverage, the rate, commitment fee also for the revolver, we'll talk about that, and whether or not you can prepay it and if you have to amortize it. All right, so let's go ahead and fill this out. All right, so we have our 3 tranches from our prompt. The amount of the revolver is going to be 0, right? So it's unfunded at close, so you're not using any capacity from your revolver to fund the transaction, right? So 0, but our capacity is 100. Leverage will be 0 here because we can leave it blank because we have no amount outstanding. The rate on the revolver per the prompt is 2%, and there's a 0.5 percent commitment fee, right? So this is basically the amount of interest they have to owe on the undrawn balance of the revolver. And so in exchange for guaranteeing that the company has $100 million revolver capacity that they can draw on, the bank will charge a rate on the amount they haven't drawn. So they'll charge let's say they drew 25 million of their 100 million. The bank will charge 2% on the 25 million and will charge 0.5% on the 75 million that they haven't yet drawn. All right, we can leave voluntary and mandatory blank for the revolver because that'll tie into our cash and debt schedule, which we'll explain later. All right, so with the term loan B, we're going to have initial leverage of 3 times. Our rate is 5%. There's 1% mandatory amort, and we can voluntarily repay it. So what I'm doing here, this is just a formatting thing. Anything before the first semicolon, right, is going to be a positive number. So I'm formatting a positive number as yes. If it's a 1, it's a yes. Between them, that's negative. So I have no formatting set for that. And then if it's 0, it's no. Right, and so what I'm going to do is I'm going to link voluntary payment to this. Right, so I'll say voluntary payment times 1, aka keep it steady, or voluntary payment times 0, which will set that to 0. Right, so this is how I can turn on and off voluntary payment. And so let's talk about our unsecured notes. We're also levering 3 times unsecured, 8% interest, and there's no mandatory, and we're not allowed to voluntarily prepay. And so this is common. This actually probably wasn't in the prompt, right? So the amortization was listed for the term loan, and it was listed that there was no amort for the unsecured notes. That's standard, right? So 1% amort on term loan is standard. No amort on notes is standard, and then it's also standard terms that you can prepay your term loan B, but you cannot prepay your notes. All right, so let's also go ahead and bring in LTM EBITDA. All right, so this is what we're going to lever off of. So you lever off of a trailing basis, a last 12 months basis. And this is because the debt investors are more conservative, right? They don't give you credit for forward EBITDA or projected EBITDA. They give you only credit for the EBITDA you have in the bag in the last 12 months. So let's go ahead and link this up to our last 12 months EBITDA, right? So one other recommendation, as you're going through this, keep the formatting kind of up to standard, right? So green for links to different tabs, blue for hard codes, right? I would go ahead and put in borders. We'll put in shades as we're going through. Help you keep it organized, and then when you're done, it'll look pretty. And that's important for these tests, right? If it's a totally unformatted model that you submit, that most likely won't go over too well. So it's definitely something that's taken into consideration on these tests. All right, so next let's go over our entry analysis. All right, so this is where we're going to calculate our purchase share price, purchase equity value, purchase enterprise value. We'll do the FTSO calculations here, and we'll add in our sources and uses. Right, so this is before we get to the projections, before we get to the pro forma balance sheet. Right, this is what you're going to want to do first. All right, so let's go ahead and take our share price and link it up to share price here. All right, and then the purchase premium, which we're also going to link up to our assumptions, 30%. Right, and so our purchase share price is going to be 30% higher than 27, or 35.1. Right, what we're going to want to multiply that by is our FDSO, our fully diluted shares outstanding, right, which we're going to need to calculate using the treasury stock method. So let's go over here and calculate our FDSO. So our basic shares outstanding is 40, right? So we have 40 basic, just already issued, front cover the 10K or 10Q number of shares, right? And then let's calculate our options, right? So we have 8 million options, which we know from the prompt. Our strike price is 13, which we also know from the prompt. And so we will also want to calculate if this is in the money, right? So that's basically saying if the purchase share price is greater than the strike price, then it's in the money. And if it's not, it's out of the money. So we're going to want to put a little check here, right? So if 35.1 is greater than 13, put a 1. If not, put a 0. Right? And we did the formatting thing here to say yes or no. And so when we do our treasury stock method formula, we'll want to multiply it by 1 or 0 so that we can't have negative dilution. Right? You can only have dilution, but if it's out of the money, it's just 0 dilution. Right? So now our dilution from options. So the formula for this is you take the purchase share price and you subtract it, and you subtract the strike price, and then you divide by the purchase share price. You multiply it by the number of options, and then you multiply it by if it's in the money. Right, so let's go over a couple ways we can kind of think about this and decide if it makes sense, right? So what's happening here is that if these options are exercised, the owners of the options need to pay $13 to the company, and the company can then use that $13 to repurchase shares, and therefore limit the dilution of the options, right? And so that's what this formula is capturing. A way you can test it. So let's say, let's set, so if you set your strike price to half your purchase price, then your dilution should be exactly half your number of options. So if you don't quite remember the formula, you're kind of testing it out in a live setting, that's a little check you can run to make sure that, okay, like I kind of forget this formula, but our, seems to be working, so all's well, right? So that's a way you can test the formula. And so let's go ahead and format this. Okay, great. So now our FDSO is going to be our basic shares outstanding plus our dilution from options. And so let's say you had another tranche of options, right? You could simply build that over here and sum both of these, right? But in this case, we don't. So let's go ahead and get rid of that. All right, so when we multiply our purchase share price by our fully diluted shares outstanding, we're going to get our purchase equity value, right? And then if we add our debt and we subtract our cash, we're going to arrive at our purchase enterprise value. So let's go ahead and link up the debt to the pre-transaction balance sheet. Right, so there is 425 of debt that we're going to add, and then we're going to want to subtract our cash of 20. And let's make these green, linking to the other tab. So the sum of these three is our enterprise value. All right. All right, and so now let's go on to our sources and uses. All right, so we want to start with our uses, right? So built within the sources, there's going to be the plug, which is the sponsor equity contribution, right? And so we'll start with our uses, we'll set our sources equal to our uses, we'll add in most of the sources, and then we'll plug the sponsor equity. All right, so let's go ahead and link all this up. So the first line item on the uses is your purchase equity price. Right, so that is the 1581 here. That's the equity that you need to buy out from the seller. And you're also going to need to refinance the debt. So let's link that up to the debt. There are going to be transaction fees and financing fees. So let's go ahead and link those up to the, make all this black. Let's go ahead and link that up to the prompt. So our transaction fees were 15 and our financing fees were 20. And then we're also going to have to capitalize the balance sheet. Right, so we're going to have to send some cash to the balance sheet, which is going to be equal to our min cash. So that's here. Right, so we're going to have to put 15 million cash to the balance sheet, and that will equal our total uses. Format this. All right, now our total sources is going to be equal to our total uses. Right, so we can start at the bottom, total source equals total uses, and then what are our other sources? Right, so term loan B, right, so if we go to our debt assumptions, let's go ahead and fill those in. So we missed that in the beginning. So 3 times our LTM EBITDA is how much term loan we're going to have, and then 3 times our LTM EBITDA is also going to be our unsecured notes. Right, so we're going to add $1,200 of debt to the balance sheet. Right, so let's link that up. Term loan B, 600. We're going to have 600 of unsecured notes. Our cash from our balance sheet, right, that's going to be how much cash was already on the balance sheet before the deal. Right, so when we buy out the shares as a public company, we're going to get to keep all that cash. Right, so it basically comes with the equity. In a public deal, that's the way that it's structured. Right, so it's and then we're going to have to capitalize the balance sheet, but we might not need to put as much cash on the balance sheet as is currently on the balance sheet, and so the difference, that $5 million difference here, is going to be a source that we could use to help fund the transaction. Right, so it's obviously not too extreme here. It's only 5 million, but let's say they were holding 200 million of cash on the balance sheet. In a public deal, you could use 185 of that to help finance the purchase if your min cash was 15. Right, so what's last? So the sponsor equity contribution is last. Right, so it's going to be equal to your total sources minus the sum of the rest of your uses, and so that's 836. Right, so now we've filled out our sources and uses. Let's go ahead and move down the line. Right, so the next thing that we're going to want to talk about here is goodwill. All right, so this is also something that we'll need to calculate our pro forma balance sheet. There are a couple ways we can go about doing it. I'll walk you through 2 ways. Right, so what I'll call method 1 is going to be, it's my preferred method. I think it makes more intuitive sense. So you take your purchase equity value, right? So you always, basically goodwill is the difference between how much you pay and the value of your assets less your liabilities on your book, right? And so let's walk through how we do this, right? So start with your purchase equity value, subtract your identifiable assets, right? So this is not intangible assets, this is identifiable. So basically all assets other than goodwill are identifiable. You can point to a patent, you can point to a trademark and say, see, I have a patent. So it's identifiable even though it's intangible, right? So, but goodwill is not even identifiable. It's considered unidentifiable. And so what we're going to want to do here is take the sum of our assets. We'll take our total current assets plus our PP&E plus our intangibles, basically everything other than goodwill. And then we're going to want to subtract this. And we'll go ahead and make this green, linking to another tab. And then we're going to want to add the sum of our liabilities. So go grab all of our liabilities. And the sum of that is equal to our pro forma goodwill. And so that's method 1. So let's talk about method 2. So method 2 I think is probably a more common method. All right, so you take your purchase equity value. All right, you start with that in both methods. You subtract the book value of your equity. All right, so let's go ahead and link this to the other tab, the book value of our equity here. And that is going to equal your change in goodwill. All right, so 2 methods. You can take your purchase equity value, subtract your identifiable assets, add your liabilities, and that'll get you pro forma goodwill. Or you can take your purchase equity value, subtract the book value of your equity, and that will get you your change in goodwill. All right, so 2 methods. You're free to use only one of these 2 methods. You obviously don't have to do it twice. Just for demonstration, showing it twice. All right, so that covers our sources and uses, our pro forma goodwill, and our entry assumptions. Next, let's go ahead and calculate our pro forma balance sheet.